Hello, my viewers. My name is Ken Mwiti. I'm gonna be taking you through the financial reporting, whereby we will be learning a lot, especially when we apply it on the accounting courses, and even for those that will be interested to dwell on their professional courses like CPAs. I think we'll be starting to deal with the very aspect in financial reporting, and that is about the partnership. That is accounting for partnership. This is where we want to see how do we treat different transactions or different contributions towards the operation of accounting type or a partnership type of business. Before everything, we'll just look onto the key features of partnership, or what are the characteristics that define partnership. What can you see in partnership and conclude that this is a partnership firm and it's not a sole proprietorship or it's not a company. One of the major feature is that partnership, its owners, it's owned and operated by two or more persons. You never meet a partnership that is operated by one person or like with 50 peoples or individuals. That's not a partnership. So one major characteristic of partnership is that it is operated by two or more persons. I think that point is at home. The second key feature is that the profit and the losses are shared in predetermined ratio. Remember, before the commencement of any partnership, we have what we call a partnership deed or some agreement on how they will be running the business, what will be their profit sharing ratio, what will be, they do lay everything down. So in the partnership deed, they dictate about the profit and loss sharing ratio. Why do we say profit and loss? Remember that in occurrence of a profit, they do share the profit. And also when the loss arises as a result of the business operation, they still share the loss among themselves or among the partners. So we say that the profit and losses are shared in predetermined ratio. Another key feature is about the interest. We say that the interest could be earned on the capital balances so as to motivate partners to retain capital into the business. Remember, whatever that is termed as capital in the partnership is individual's contribution. Take an example, you have 5 partners and they want to raise 100,000, maybe to start a business requiring them 100,000. They may agree to raise that capital using different proportions. But remember now, they are motivated. They are motivated to retain their capital into the business by earning some interest from the capital that they have in the partnership form of business. For example, if you have introduced 20,000 into partnership business, you are entitled maybe to 5% interest on capital. So you realize that as the business is running, you'll be motivated to retain your amount there so as you continue to accumulate the interest that comes as a result of your capital balances being in operation. Another key feature is about the interest still. We say that interest could be changeable on withdrawn capital so as to discourage partners from depleting their capital. This is just an opposite of what we have said, that interest could be earned on capital. Now, the interest could be changed on withdrawal of the capital from the business. Remember, if there is no limitations maybe to withdrawing the capital, many partners will within no time be withdrawing their capital with no reason. And for that matter, you realize the business might start collapsing or maybe the business might lose its liquidity or its ability to settle the current liabilities since they have nothing with them as capital. Another important factor to note is that a partnership is not subject to taxation, but the individual partners are individually taxed. Remember that when we talk of taxation, you realize like in companies, they have what we call corporation tax. I think by now it is standing at 30%, where the overall net profit acquired or realized by the company is subjected to a corporation tax of 30%. But remember, partnership at some point, it may behave as large or as expansive as company, but remember that it is not taxed as partnership, but instead individual partners are subjected to tax using the appropriate tax bracket. I think that point is at home. Another key feature is that the partnership have unlimited liability towards the partnership debt. What do we mean by unlimited liabilities? We mean that for example, in a situation where the partnership or the amount, maybe in case of dissolution, and the partnership is unable to settle its liabilities, maybe to creditors or whichever the case, individual partners can be asked to contribute towards settling of that debt. That's why we say they have unlimited liabilities, meaning that they themselves, they can take part in settling the partnership debt in case the partnership itself is unable to settle the debt. I think that point is also at home. Another important factor is that partners are governed by partnership deed, which is a contract spelling out the right and obligation of each partner. Remember that partnership, yes, it is formed by many people or by two or more people, but remember that not each and every person had to take direct control over the business. Maybe they might be somehow busy in their several other activities. They might decide now to have some of them being employed or being appointed as salaried employees who will be at operation each and every time. But remember, there are those now that will be maybe not available for the operation or for the running of the business or for the management of the business. Now they have what we call the partnership deed. This is like the constitution that guides them. We say that the partnership deed outlines each and every aspect that should be going on around or revolving around the partnership. And at some time and some instances when they don't have partnership deed or when they are not guided by the deed, they do form some agreement. Remember that these are individuals, and they won't operate without some form of agreement. Another point, the last one, is that in case a partner retires or dies, or a new partner is admitted, the old partnership stands dissolved and a new one is formed. Remember that this operation is started by peoples or by individuals who are subject to anything that can or they can be victim to anything. They can die, or someone can think, or they can retire, or someone can think to that not to continue in partnership. So we say that in those cases, either of death, either of admission, maybe they started partnership, maybe they are 5. They might decide now to hand the 60th one or the 60th partner. Remember that in case of those all issues, either death, the admission of a new partner, or maybe they agree to dissolve, maybe they can agree to dissolve the partnership, or at any instance, we say that the whole partnership stands dissolved and a new one is formed. I think next class, we'll be following on the accounting, or how do we account in partnership. Maybe in case there is admission of a new partner, there is a death of a partner, there is all those, or there is even the dissolution. Much welcome to the next class. Kindly, right? I remind you to subscribe, follow, and comment. And I know you will, the lessons will be of great value, or to you, especially as an accounting student, or a student who is performing any other professional course related to accounting. Thank you very much.